Before we begin, please note that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided in this video is not intended as financial or legal advice. You should always consult with a qualified professional before making any decisions regarding your insurance policies. Your financial situation is unique, and the tips and strategies discussed here may not be suitable for everyone. You are being overcharged for car insurance. I'm not talking about by a few dollars. I'm talking about hundreds, maybe even thousands of dollars every single year. And the worst part? You've been led to believe this is normal. Think about it. When was the last time you opened your auto insurance bill and felt good about it? For most of us, it's a moment of quiet frustration. You see that number, your stomach sinks a little, you sigh and you pay it. Because what else are you going to do? You need to drive. It's a legal requirement. It feels like another tax, a non-negotiable cost of living in America. But what if I told you that for millions of Americans, nearly half of that bill is a loyalty tax or a confusion tax? A fee you're paying for not knowing the simple secrets the insurance industry quietly uses to maximize its profits. The average American now pays over $2,000 a year for full coverage auto insurance. $2,000? That's a vacation. That's a significant chunk of a mortgage payment. That's an emergency fund. And it's being siphoned out of your bank account every year, often for the exact same coverage you could get for $1,000 or $1,200 or $1,500. In this video, I am going to pull back the curtain. I'm going to give you the playbook. We're going to dismantle the system piece by piece and show you exactly where your money is going and, more importantly, how to get it back. This isn't about finding one or two measly discounts. This is about fundamentally changing your relationship with your insurance company. It's about transforming you from a passive bill payer into an empowered, savvy consumer who dictates the terms. By the end of this, you will have a clear step-by-step action plan with simple, powerful tricks that could slash your auto insurance premium by 30, 40, or even 50%. So how did we get here? Why is this one bill so confusing and expensive? It's because the entire system is designed to be a black box. You give them your information, your age, your car, your address, and they feed it into a mysterious algorithm that spits out a number. That number feels final, feels like a fact, but it's not. It's an opening offer. It's a carefully calculated price based on hundreds of data points, and many of them have nothing to do with how well you drive. They're betting on one simple human behavior: inertia. They know that once you sign up, you're likely to stay. Life gets busy. You set up autopay. The bill becomes background noise. And that's where they get you. This is what's known as the loyalty penalty. It's one of the dirtiest little secrets in the industry. You would think that being a loyal customer for 5, 10, or 15 years would earn you the best rates, right? Wrong. In many cases, it does the exact opposite. Insurers know that long-term customers are less likely to shop around. So year after year, they perform what they call price optimization. It's a fancy term for slowly creeping your rates up, little by little, betting you won't notice or won't bother to leave. They're literally charging you more because you're loyal. Meanwhile, they're offering massive discounts and teaser rates to new customers to lure them in. So the person who just switched to your company is likely paying far less than you are for the exact same coverage. You're subsidizing their discount. It's a system that punishes loyalty and rewards shopping around. Let me tell you about a guy we'll call Mark. Mark is the perfect example. He's in his late 30s, married, has a good job, and a clean driving record. Not a single accident or ticket in over a decade. He'd been with the same big-name insurance company since he was in college. He thought he was getting a great deal. He had the good driver discount, the loyal customer discount, the multi-policy discount for bundling his auto and renter's insurance. He felt like he had checked all the boxes. He was paying about $1,800 a year for his 2017 Honda Accord. He thought that was just the going rate. Then one day at a barbecue, he was talking to his friend Dave. Dave had just bought a brand new SUV, something much nicer and more expensive than Mark's Honda. Naturally, Mark assumed Dave's insurance must be through the roof. He asked him what he was paying. Dave pulled out his phone, checked his app and said, "Looks like it's about $100 a month." Mark did the math in his head. $100 a month. That's $1,200 a year. $600 less than what he was paying for a brand new, more expensive vehicle. How was that possible? Dave didn't have a perfect record. He'd had a fender bender 2 years ago. It made no sense. Mark went home that night and fell down a rabbit hole. He was annoyed, then he got curious, and then he got obsessed. He realized that for 15 years he hadn't been a customer, he'd been a subscription. He had treated his car insurance like his water bill or his Netflix account, a fixed cost he just had to pay. That was his first mistake. And it's the mistake almost all of us make. We fail to understand the fundamental nature of the transaction. Here is the single most important mindset shift you need to make, and we need to make it right now before we get into any of the specific tricks. Your insurance company is not a utility. It is not a government agency. It is a retail business. They are selling a product and you are the consumer. Just like Best Buy, Target, or Amazon, they have competitors. Dozens of them. And they are all fighting for your business. You wouldn't buy a television without checking the price at a few different stores, would you? You wouldn't sign a new cell phone contract without seeing what Verizon, AT&T, and T-Mobile are all offering. You hold the power. Your premium is their revenue. You are the prize. Once Mark understood this, everything changed. He stopped asking, "What do I have to pay?" and started asking, "What are you willing to offer to earn my business?" He went from being a price taker to a price maker. This is the foundation for everything we are about to cover. You are in the driver's seat, not just in your car, but in this negotiation. The problem is, most people never even realize they're in a negotiation to begin with. They accept the first number they're given and never question it again. The insurance companies have spent billions of dollars in advertising to build an image of a friendly neighbor, a helpful gecko, or a funny emu. They want you to feel comfortable. They want you to feel like you're part of a family, because families don't haggle. Families don't shop around for a better deal on Thanksgiving dinner. It's a brilliant psychological strategy, but at the end of the day, it's a business transaction, and you need to start treating it like one. So what did Mark do? He armed himself with this new mindset. He realized his loyalty hadn't been rewarded. It had been exploited. He saw that his good driver status was just a baseline, not a golden ticket to the lowest rates. He understood that the price he was paying wasn't a fixed reality, but a fluid number based on a game he didn't even know he was playing. The game is rigged in their favor, but once you learn the rules, you can start to win. Mark's journey from paying $1,800 a year to just over $900 a year for the exact same coverage didn't involve any complex financial wizardry. It didn't require him to change his car, move to a different state, or compromise on his coverage. It just involved a series of simple strategic steps. Small adjustments to his profile, a few targeted questions, and one crucial technique for shopping that forces companies to compete for his business in a way they never would have otherwise. And it all started with one single action. One phone call that took him less than 15 minutes. A call that most people are terrified to make, but one that instantly put hundreds of dollars back in his pocket before he even considered switching companies. And in the next part, I'm going to tell you exactly who he called, what he said word for word, and how you can use the exact same script to unlock the first and often largest hidden discount on your policy. So Mark took a deep breath, his phone feeling strangely heavy in his hand. This is the moment most people dread. The confrontation. The awkward conversation where you have to ask for a better deal. It feels like you're begging, or worse, that they'll just say no and you'll have wasted your time and energy. But what I'm about to share with you isn't about confrontation. It's about conversation. It's not about begging. It's about business. The script Mark used isn't magic, but it works like magic because it's built on a few simple, powerful principles of human psychology and business logic that insurance companies understand perfectly. First, who did he call? He didn't call some random 1-800 number. He looked up the direct line for his local agent, or if he didn't have one, he called the main customer service line and asked to speak to someone in customer retention or loyalty. Those are the key words. You don't want to talk to the person who signs up new clients. You want the person whose entire job is to keep you from leaving. Their department has a budget for discounts specifically for this purpose. They are authorized to give you a better deal. Before he even dialed, Mark did one crucial thing. He gathered 3 pieces of information and put them on a sticky note right next to his computer. 1. His policy number. 2. How many years he'd been a loyal customer with the company. For Mark, it was 6 years. 3. His driving record. He hadn't had an accident or a ticket in over 5 years. This is your ammunition. You're not going into this conversation empty-handed. You're going in as a valuable, low-risk, long-term customer. You are, in fact, their ideal client. And you need to gently remind them of that. Okay, so the phone rings. A friendly voice answers. Here is the script, word for word, and the powerful reason each part works. The agent says, "Thank you for calling ABC Insurance. "This is Brenda. How can I help you?" And Mark starts with simple, disarming politeness. He says, "Hi Brenda, my name is Mark Smith. I'm hoping you can help me out today. I've got my policy number right here if that helps. It's 9-8-7-6-5. Let's break that down." He's friendly. He's organized. He immediately gives his policy number. This signals to the agent that this is a serious professional call. He's not just a random person complaining. He's a customer who is prepared. This small step instantly changes the dynamic of the call and puts the agent on his side. Next, the agent pulls up his account. Mark doesn't wait. He goes right into the setup. He says, "Great. So I've been a happy customer with you guys for about 6 years now, and I've always appreciated the service. I'm calling today because my renewal is coming up, and the premium has increased quite a bit. To be honest, it's a little higher than I was expecting." This is the loyalty and concern phase. Notice what he did. He started with a compliment. "I've been a happy customer." This isn't just flattery. It tells the agent he wants to stay. He's giving them a chance to keep him. He's not an angry customer calling to cancel. He's a concerned customer calling for a solution. Then he states the problem simply and without emotion. "The premium has increased, and it's higher than I was expecting." This is a completely reasonable, non-confrontational way to open the negotiation. Now comes the most important part of the entire script. This is the leverage. This is the sentence that makes the agent sit up a little straighter and switch from customer service mode to customer retention mode. Mark continues in a calm, friendly tone. "So I did a little bit of shopping around online, and I've received a few quotes from other companies that are, well, they're significantly lower for the exact same coverage. Now, I'd much rather stay with you all since I've been here for 6 years, but the difference in price is making it really hard to justify." Boom. That is the million-dollar sentence. Let's dissect it. I did a little bit of shopping around. This shows you've done your homework. You're not just guessing, you have real data. I've received a few quotes that are significantly lower. He's not aggressive. He's not threatening. He's stating a fact. He's creating a business problem for the agent that she is now motivated to solve. And then the masterstroke. "I'd much rather stay with you all, but the price is making it hard to justify." This is the golden key. He's telling her, "I am on your side. I want to give you my money. You just need to give me a reason to do it." He's turned her from an adversary into a partner in solving his problem. He has made it easy for her to be the hero. At this point, the agent will typically put him on a brief hold. This is a good sign. She's not just brushing him off. She's going into the system. She's looking for the discounts. She's talking to a supervisor. She is actively working to keep his business. When she comes back, Mark is ready for the final piece of the script. The ask. He doesn't demand. He invites. After she explains whatever she found, Mark says, "Okay, I appreciate you looking into that. So based on my loyalty, my clean driving record, and the competitive quotes I've found, what is the absolute best rate you can offer me today to keep me as a customer?" Let's look at that wording. He summarizes his value. My loyalty, my clean driving record. He reminds her of the threat, the competitive quotes, and then the beautiful open-ended question. What is the absolute best rate you can offer me? He's not asking for a specific number. He's empowering her to give him the best possible deal she is authorized to give. He's making her the expert. It's a brilliant psychological move that puts the ball entirely in her court. So what happened with Mark? Brenda, the agent, put him on hold for about 3 minutes. When she came back, she said, "Okay, Mr. Smith. I see you've been with us for 6 years with no claims. We value your business. I was able to apply a long-term customer discount, and I also found a defensive driver discount you were eligible for, but wasn't on your account. With those 2 adjustments, I can bring your 6-month premium down from $950 to $780. One phone call, about 10 minutes of his time, and Mark saved $170. That's over $340 a year. He didn't yell, he didn't threaten, he didn't even have to switch companies. He just followed a simple, polite, and powerful script. He turned an awkward chore into a $340 payday. You can do this. Anyone can do this. The script is right there. But here's the secret most people miss. That $170 discount was just the beginning. It was the low-hanging fruit, the discount the agent was allowed to give him over the phone. But what Mark discovered next was that his actual policy documents were a treasure map, filled with hidden discounts and coverage traps that even the agents don't always tell you about. The phone call is step one, but the real money, the deep savings, are buried in the fine print. And in the next part, we are going on a treasure hunt. I'm going to show you how to read your own policy and identify the 5 most common and most expensive mistakes that are almost certainly costing you hundreds, if not thousands of dollars every single year. Alright, grab your policy declarations page. If you don't have it, pause this video right now, log into your insurance company's website and pull it up. It's usually a 1 or 2 page summary of your coverage. This is our treasure map. And on this map are 5 X's that mark, not treasure but financial traps. Let's find them. The very first thing I want you to look for is a set of 3 numbers separated by slashes. It'll look something like 25/50/25 or 50/100/50. This is your bodily injury and property damage liability. This is the single most important part of your policy, and it's mistake number 1. Most people make one of 2 critical errors here. They're either dangerously underinsured, or they're paying for a level of coverage that doesn't match their life. Let's break down those numbers. If your policy says 25/50/25, it means your insurance will pay a maximum of $25,000 for injuries to one person in an accident you cause, a maximum of $50,000 for all injuries total in that accident, and a maximum of $25,000 to repair or replace the other person's car and property. Now let me ask you a question. When was the last time you saw a new car on the road that cost less than $25,000? A new Ford F-150, the most popular vehicle in America, starts at over $36,000. A Honda CR-V is nearly $30,000. If you cause an accident and total one of those cars with a $25,000 property damage limit, your insurance pays the first $25,000. The rest? The other $5,000, $10,000, $15,000? That comes out of your pocket, your savings. Your paycheck gets garnished. Your house could get a lien put on it. All because you tried to save maybe $10 a month by getting the state minimum coverage. It's like showing up to a house fire with a water pistol. The opposite mistake is having limits that are too high for your needs. If you're a 22-year-old renting an apartment with $5,000 in savings, you probably don't need the millionaire level 250/500/100 coverage. So what's the secret? The sweet spot for most middle-class Americans is 100/300/100. That's $100,000 for one person's injuries, $300,000 total for injuries, and $100,000 for property damage. This provides robust protection against the vast majority of accidents without the premium cost of the absolute highest tiers. The price difference between the state minimum and this level of solid protection is often less than the cost of a few cups of coffee a month. Check your numbers. If you're at the state minimum, you're playing financial Russian roulette. Get a quote for 100/300/100. Okay, map readers, let's find the second trap. Look for the words comprehensive deductible and collision deductible. This is mistake number 2, the low deductible trap. Your deductible is simply the amount of money you have to pay out of pocket before your insurance kicks in for a claim. A lot of people choose a low deductible like $250 or $500 because it feels safer. Feels like you're paying less if you get in an accident. But you're not. You're just paying more every single month for the rest of your life. Let's do some simple math. Let's say raising your deductible from $500 to $1,000 saves you $30 a month on your premium. That's $360 a year. In this scenario, you're paying an extra $360 every year, just to avoid paying an extra $500 once, in the event you have an accident. You would have to go less than a year and a half without a single at-fault accident for this to make financial sense. The average driver files a collision claim only once every 17.9 years. You are paying thousands of extra dollars over the life of your policy for a what-if scenario that is statistically unlikely to happen. The trick here is to self-insure for the small stuff. Raise your deductible to at least $1,000. Take the money you save every year, that $360 in our example, and put it into a dedicated savings account. In less than 3 years, you'll have more than the $1,000 deductible saved up. From that point on, you are literally just pocketing the savings year after year after year. Now for mistake number 3, and this one is terrifying. Look for uninsured or underinsured motorist coverage. This is often abbreviated as UM/UIM. Some people, in a desperate attempt to lower their bill, will waive this coverage entirely. This is one of the most dangerous financial mistakes a driver can make. 1 in 8 drivers in the United States is on the road right now with zero insurance. 1 in 8. Imagine you're sitting at a red light, and someone plows into the back of your car. It's clearly their fault, but they give the police an expired insurance card, or they have no card at all. Your car is wrecked. You have medical bills piling up. You can't work. Who pays for all of this? If you waived your uninsured motorist coverage, the answer is, you do. All of it. The person who hit you has no insurance and likely no assets. You can sue them, but you can't get blood from a stone. Your life can be financially ruined by someone else's irresponsibility. Uninsured motorist coverage protects you from that nightmare. It steps in and acts like the other driver's insurance. It is not expensive, and it is worth every single penny. Do not waive this coverage. Make sure your UM/UIM limits match your own liability limits. Let's move on to mistake number 4, the silent money waster. Find the line item for medical payments, or in some states, personal injury protection, PIP. This coverage pays for your medical bills and those of your passengers after an accident, regardless of who is at fault. It sounds great, right? But here's the problem. If you have good health insurance, you are very likely paying twice for the same coverage. Your health insurance already covers you for injuries, whether you get them falling down the stairs or in a car accident. So you're paying a premium to your health insurance company, and then you're paying another premium to your auto insurance company for overlapping benefits. This is a classic case of financial waste. Now, some states require a minimum amount of PIP, and you can't get around that. But many people are paying for far more than the state-required minimum. Here is your mission. Look at how much medical payments or PIP coverage you have. Is it $5,000? $10,000? More? Now find your health insurance card. Call the number on the back and ask them this exact question. How does my health insurance coordinate with my auto insurance policy's medical coverage in the event of a car accident? They'll tell you which policy is primary. In most cases, if you have a good PPO or HMO plan, you can safely lower your auto medical coverage to the state minimum and let your primary health insurance handle the rest. This one change can save people $50 to $150 a year. Finally, mistake number 5, the junk drawer coverages. These are the little add-ons that sound useful but are often redundant and overpriced. I'm talking about rental reimbursement and towing and labor. Look for them on your policy. They might only be $6 or $7 a month each. You barely notice them. But that's the trap. That's $12 to $15 a month, nearly $200 a year, for services you probably already have. Do you have a AAA membership? If you do, you already have towing. You're paying twice. Do you have a premium credit card, like a Chase Sapphire or an American Express? Many of them provide rental car coverage or other roadside assistance benefits. Do you have a second car in your household? If so, could you use that car for a few days while your primary car is in the shop, instead of paying $100 a year for a rental benefit you might never use? These are the tiny leaks that sink the ship. Go through your wallet, check your credit card benefits, check your AAA membership. If you have overlap, cut these coverages from your auto policy immediately. It's free money. So there you have it. The 5 hidden traps on your insurance treasure map. By simply adjusting your liability limits to a sensible level, raising your deductible, ensuring you have uninsured motorist coverage, eliminating redundant medical payments, and cutting the junk drawer add-ons, you have likely identified hundreds, potentially over $1,000 in savings and improved protection. But finding the money we're wasting is only step 1 of the mission. Now we have to go on the attack. We have to actively hunt down the savings your insurance company doesn't want you to know about. In the next part, we are diving deep into the world of discounts. And I'm not talking about the obvious ones. I'm talking about the secret little-known discounts for your profession, for the technology in your car, even for how you pay your bill, that can stack on top of each other and slash your premium by an additional 20 to 40%. This is where the real treasure is buried. And the map to that treasure isn't complicated. It doesn't require a secret decoder ring. It just requires knowing where to look, and most people are looking in all the wrong places. They think the only discounts are for being a good driver or a good student. But that's just the tip of the iceberg. The real savings, the deep cuts, come from a series of discounts based on 3 simple categories: who you are, what you drive, and how you pay. Let's break that down. First, let's talk about who you are. This goes way beyond your age or your driving record. Insurance companies are obsessed with data, and they've spent billions of dollars figuring out which groups of people are statistically less likely to get into an accident. And they reward those groups with lower rates. The crazy part? They don't always advertise it. You have to ask, We're talking about your profession. Are you a teacher? An educator of any kind? There's a discount for that. Why? Because statistically, teachers are found to be more cautious, more responsible drivers. Are you an engineer? A scientist? A certified public accountant? There are discounts for you too. The data suggests people in these detail-oriented, analytical professions tend to be more risk-averse behind the wheel. The same goes for first responders, firefighters, police officers, EMTs, and paramedics. They see the consequences of bad driving every single day, and insurers bet that this makes them safer drivers. And what about nurses and doctors? Absolutely. These are all considered low-risk professions, and there is likely a discount waiting for you with your name on it. If you're in one of these fields and you're not getting a discount, you are leaving money on the table. Period. But it doesn't stop at your job title. It extends to your affiliations. Where did you go to college? Many insurance companies have partnerships with alumni associations. Being a graduate of a certain university can knock a few percentage points off your premium. Are you a member of a professional organization? The American Bar Association, the National Association of Realtors, a trade union? Check their member benefits page. You'll be shocked at how many have negotiated special group rates on auto insurance. Think about this. Even being a member of a wholesale club like Costco or Sam's Club can unlock a special rate. Being a member of a credit union is another huge one. These organizations have massive memberships, and they use that leverage to strike deals with insurance carriers to offer their members a better price. It's a win-win. The insurer gets access to a huge pool of potential customers, and you get a discount just for being a member of a club you already belong to. Many people are members of 3 or 4 of these groups and have no idea that each one is a potential key to a lower rate. You need to make a list of every group, every association, every single organization you belong to, and ask your insurance agent about every single one. Next, let's look at the second category. What you drive. Again, we have to go deeper than the obvious. Everyone knows a boring 4-door sedan is cheaper to insure than a 2-door sports car. That's entry-level knowledge. The treasure is hidden in the details of your specific vehicle. The safety and security features that are built right in. Back in the day, this meant getting a discount for anti-lock brakes or having dual airbags. Today, that's standard. The new frontier for discounts is the advanced safety technology that's becoming common in modern cars. I'm talking about your car's advanced driver assistance systems, or ADAS. Does your car have blind spot monitoring, lane departure warnings, adaptive cruise control? How about automatic emergency braking? That last one is huge. A system that can automatically hit the brakes to prevent or lessen the severity of a forward collision is a massive risk reducer in the eyes of an insurer. But here's the secret. Insurance companies are notoriously slow to update their systems. They might not automatically know your 2021 Honda Civic has a full suite of these safety features. Your car's VIN number might tell them the basics, but it doesn't always tell them about optional safety packages. You have to explicitly tell them. You need to say, "My vehicle is equipped with automatic emergency braking and lane keep assist." What discounts are available for those specific features? Don't be surprised if the agent has to go look it up. That's a good sign. It means you've found a discount that most people miss. The same goes for anti-theft devices. If your car has a passive alarm system that automatically arms itself, that's one level of discount. But if you have an active recovery system, something like a LoJack that can be tracked if it's stolen, that's a completely different, and usually much larger, discount. Another tiny trick? VIN etching. For a very small cost, you can have your car's vehicle identification number etched into the windows. It makes the car harder for thieves to part out and sell. And for that, some companies will give you a small but permanent discount on your comprehensive coverage. It's a tiny detail that pays for itself over and over again. Finally, let's talk about the third category, which might be the easiest one of all. How you pay. Insurance companies are businesses, and like any business, they love 2 things: predictable income and lower administrative costs. You can use this to your advantage. The most common discount here is the paid-in-full discount. Most people pay their car insurance bill month to month because it feels more manageable. But insurers charge you a fee for that convenience, often a few dollars per installment. If you can afford to pay your entire 6-month or 1-year premium all at once, upfront, most companies will give you a significant discount, often ranging from 5 to 10%. Think about that. Where else can you get a guaranteed 10% return on your money in 6 months? It's one of the best and simplest ways to save. Don't have a lump sum sitting around? You can still save. Ask about the discount for setting up automatic payments from your checking account, often called an EFT or electronic funds transfer discount. This guarantees the insurer they get paid on time, every time, without having to mail you a bill or process a check. Saves them labor and postage, and for that they'll knock a few bucks off your bill. While you're at it, sign up for paperless billing. That's another easy discount. Going paperless saves them even more money on printing and mailing, and they'll often give you another small, recurring discount just for clicking a button that says Go Paperless. Now, here is the most important part of this entire strategy. None of these discounts exist in a vacuum. The real power comes from stacking them. It's like a combo move in a video game. Each one you add makes the final blow that much more powerful. Let's imagine a driver. Let's call her Jessica. Jessica is a 35-year-old registered nurse. She drives a 3-year-old Subaru with blind spot monitoring. She's a graduate of Ohio State University, and she's a member of a National Nursing Association. She's been with the same insurance company for 5 years. Jessica thought she had a good rate because of her clean driving record. But after learning about these hidden discounts, she makes a call. She asks about a discount for being a nurse. That's a 5% savings. She asks about her alumni association. Turns out her insurer has a partnership. That's another 4%. She mentions her car's specific safety features, which the insurer didn't have on file. That's another 5%. Then she agrees to pay her next 6-month policy in full and go paperless. That's another 8%. Just by making one phone call and asking 4 or 5 specific questions, she stacked discounts totaling 22%. On a $1,500 annual policy, that's $330 back in her pocket. She didn't become a better driver overnight. She didn't move to a cheaper zip code. She just learned how to ask for the discounts she already deserved. This is the treasure. It's not one big thing. It's a dozen small things that, when combined, lead to a massive change in what you pay. So your mission right now is to become a discount detective for your own life. Grab a piece of paper or open a new note on your phone. Make a list. What is your profession? What organizations do you belong to? What specific safety and anti-theft features does your car have? Write it all down. Every single potential discount. Because having this list is one thing. Knowing how to use it to negotiate with a live insurance agent on the phone, that's a whole other skill. And it's a skill that can feel like walking into a high-stakes poker game blindfolded. On the other side of the table is the house, a multi-billion-dollar corporation. In their hand, they're holding all the cards. Complex pricing algorithms, discretionary discounts, and a deep understanding of their own profit margins. And in your hand, you're holding that list we just made. It might feel like a pair of twos, but I'm here to tell you that if you play that hand correctly, you can win. You can walk away from that table with hundreds, maybe even $1,000 back in your pocket. The secret isn't about bluffing. It's not about being aggressive or demanding. In fact, that's the fastest way to lose. The single most important rule of negotiating with your insurance company is this. The person on the other end of the line is not your enemy. They are your key. They are the gatekeeper to the savings you want. And your job is to make it as easy as possible for them to open that gate for you. Think about it. These agents are on the phone all day. They deal with angry, frustrated people who blame them for high rates. They get yelled at, they get sworn at. Imagine you're that agent, and after 5 straight calls from angry customers, you get a call from someone who is polite, prepared, and friendly. Who do you think you're going to work harder for? Who are you going to dig a little deeper for to find that extra 5% discount? Your entire strategy should be built around this one principle. You and the agent are a team. Your mission, which you state clearly and politely, is to work together to lower your premium. You're not accusing them of overcharging you. You're asking for their help to find savings you might have missed. This simple psychological shift is the foundation of everything that follows. So before you even pick up the phone, let's get your battle station ready. You need 3 things in front of you. 1, that list of every potential discount we just talked about. 2, a copy of your current policy's declarations page. This is the summary of your coverage, and it's crucial. You can usually download it from your insurer's website. 3, at least one competitor's quote. You don't have to lead with this, but having it is your ace in the hole. Okay, deep breath. You're ready. You dial the number. Someone picks up. This is the moment of truth. Most people stumble here. They're either too aggressive or too timid. We're going to be neither. We're going to be calm, confident, and collaborative. Here is your opening script. Memorize it. Hi, my name is your name. And my policy number is your policy number. I'm calling today to do a quick review of my policy. I've been a customer for a while now, and I just want to make sure I'm still getting the best possible rate and taking advantage of all the discounts I qualify for. Is now a good time to chat for a few minutes? Let's break down why this is a perfect opening. You've identified yourself clearly. You've stated a simple, non-confrontational purpose for your call. A quick review. You've subtly reminded them of your loyalty. I've been a customer for a while. And most importantly, you've shown respect for their time by asking, "Is now a good time?" You have immediately set a positive, collaborative tone. 99% of the time, they will say yes. Now the game begins. They'll pull up your policy. This is where you deploy your list, but not by just reading it at them. You're going to turn it into a series of questions. You're going to guide them through your policy, checking for discounts together. You start with the easy stuff. Great, thank you. I was looking over my policy and I just wanted to double-check a few things. First, can you confirm that you have me down for being claim-free for the past 5 years? Let them check. Let them confirm. Check. Next. Awesome. I also noticed that my car has anti-lock brakes and daytime running lights. I just want to make sure that the vehicle safety discount is being applied correctly. Could you take a look at that for me? Again, you're not accusing. You're asking them to look for you. You're on the same team. Now you move down your list one category at a time. Let's say you took a defensive driving course. I recently completed a certified defensive driving course, and I have the certificate here. Could you help me see if I can get that discount added to my policy? What about your job or affiliations? I work as your profession / I am a member of your association like AAA or AARP. I've heard that you sometimes offer professional or affinity group discounts. Is that something you could check on for my account? You see the pattern? It's a calm, methodical process. You are leading the dance. You're not overwhelming them. You're giving them one thing to check at a time, letting them have small victories on your behalf. Every time they find a discount for you, you thank them. "Oh, that's fantastic. Thank you for finding that." Positive reinforcement works on everyone. After you've gone through your entire list of personal details, car features, and affiliations, it's time to escalate, but gently. This is where you play the loyalty card. Your tone is still friendly, but now it's also a little more serious. You say something like this: "Thank you so much for checking on all of that. I really appreciate it. Now, I've been a loyal customer with insurance company name for a number of years, and I've never missed a payment. I really like being with your company and I prefer not to switch. However, my renewal rate is still a bit higher than I was hoping for. To be transparent, I have received some quotes from other companies that are significantly lower. My goal is to stay with you, but I also need to be financially responsible. With my long history with the company, is there any kind of long-term customer or loyalty discount you can apply to make my rate more competitive?" This is the velvet hammer. You've been incredibly polite. You've praised them. You've stated your desire to stay. But you've also clearly and calmly introduced the threat of leaving by mentioning competitor quotes. You've created a reason for them to fight to keep you. This often unlocks a new tier of discretionary discounts that are not publicly advertised. The agent may have to put you on a brief hold to talk to a supervisor. This is usually a good sign. It means they're working for you. When they come back, they'll present you with a new lower number. This is where most people say thank you and hang up. But we are not most people. We have one more card to play. It's the single most powerful question in any negotiation. After they give you the new quote, pause for a second. Then, in a very genuine and polite tone, you ask, "Okay, thank you for that. That is definitely better. Just one last question before we finalize everything. Is that the absolute best rate you can offer me?" And then you do the hardest thing of all. You stay silent. Don't say another word. Let the silence hang in the air. This question, delivered politely, does something magical. It forces the agent to do one last mental check. It makes them question if there is any other possible stone left unturned. They might have been holding back a final, small discount. This question gives them the justification to apply it. You'll be shocked at how often this one simple question can shave off another 5 or 10%. Now, what if they say no? What if they say, "I'm sorry, but that's the best I can do"? No problem. You don't get angry. You remain gracious. You say, "I understand. Thank you so much for your time and for looking into all of this for me. I really appreciate your help." You end the call on a positive note. Why? because you might be calling back in 6 months and you might get the same agent. You always leave the door open. This entire process from start to finish is a carefully choreographed performance. You are the director and the agent is your star actor. Your job is to give them the script and the motivation to give an award-winning performance that saves you money. By being prepared, polite, and strategic, you transform a dreaded chore into a powerful financial tool. You've taken your pair of twos and played it like a royal flush. But here's the thing. We've just spent all this time fighting for 5% here, 10% there, stacking up all these little discounts. And that's incredibly important. But what if I told you that the single biggest lever you can pull to slash your insurance bill has nothing to do with any of these discounts? What if the key is hidden in plain sight on that declarations page we had you pull up, in a section most people don't even understand? It's something called your coverage levels, and you are probably paying for way more insurance than you actually need. Think of your insurance policy not as a single product, but as a bundle of mini policies. A combo meal. And just like at a fast food joint, they often load that combo meal with things you didn't ask for and don't really need just to pump up the price. Your job is to unbundle it. To order a la carte. Let's start with the big one, the one that's legally required in almost every state. Liability coverage. On your declarations page, you'll see this listed as two separate things. Bodily injury liability and property damage liability. It often looks like a series of numbers separated by slashes, something like 50/100/25 or 100/300/50. This isn't a secret code. It's the absolute core of your policy, and understanding it is the first step to taking back control. Let's break it down. Liability coverage has absolutely nothing to do with you, your passengers, or your car. Pays for the other person. It's the "I'm sorry I messed up your car and hurt you. Please don't sue me for everything I own" fund. That first number in a 100/300/50 policy, the 100, is the maximum amount in thousands of dollars that your insurance will pay for a single person's injuries in an accident you cause. So $100,000. The second number, the 300, is the maximum total amount they'll pay for all injuries in a single accident you cause. So if you hit a car with 3 people in it, your insurance will pay out a maximum of $300,000 total for their medical bills, but no more than $100,000 to any one of those individuals. The third number, the 50, is the maximum they'll pay for property damage. This is for the other person's car, or if you take out a mailbox, a fence, or the front of a coffee shop. In this case, $50,000. So, how much do you actually need? The standard advice is to get as much as you can afford. But that's insurance companies speak for. Give us as much money as possible. The real answer is, you need enough liability coverage to protect your assets. Think about it. If you cause a serious accident and the damages exceed your coverage limits, the other party can sue you personally for the difference. They can go after your savings, your investments, even your house. So, a good rule of thumb is to have your liability coverage match your net worth. If you're just starting out, you have $5,000 in savings and a 10-year-old car to your name, you probably don't need a massive 250/500/100 policy. The state minimum might be too low and leave you exposed, but you likely don't need the platinum-plated plan. Conversely, if you own a home, have a healthy 401k, and other investments, you need higher limits to shield those assets from a lawsuit. This is where you don't want to skimp, but for millions of Americans, they're paying for liability coverage that protects a level of wealth they simply don't have yet. Go look at your numbers. Do they make sense for your financial reality today? Adjusting these levels up or down to accurately reflect your personal risk is a huge, immediate way to adjust your premium. Okay, that's the part that covers the other guy. Now let's talk about the coverages that protect your car. This is where the real magic happens, and where insurance companies make a fortune off of people's fear and lack of knowledge. I'm talking about collision and comprehensive coverage. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if you get into an accident with another object. Another car, a pole, a guardrail, and it's your fault. Comprehensive coverage is sometimes called other than collision. It's for all the weird stuff. A tree branch falls on your car during a storm. A deer decides to play chicken with your front bumper. Your car gets stolen. Hail damage. Vandalism. Acts of God and acts of criminals. For both of these coverages, there is one critical word you need to find on your declarations page: deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company pays a single dime. A common deductible is $500. This means if you have $3,000 worth of damage, you pay the first $500, and the insurance company pays the remaining $2,500. Here is one of the simplest, most effective tricks in the book. Raising your deductible from, say, $500 to $1,000 can lower your premium for collision and comprehensive by 15 to 30%. Sometimes more. Think about it. You're telling the insurance company, "Don't bother me with the small stuff. I'll handle the first $1,000 of risk myself." They love that. Less risk for them means a lower price for you. If you have a decent emergency fund, raising your deductible is one of the smartest financial moves you can make. You're betting on yourself, and over the long run, you will almost always win that bet. But now for the master level move. The one that can save you not just 15%, but potentially 50% or more on your total bill. It's a simple question you have to ask yourself. Do I even need collision and comprehensive coverage at all? Let me tell you about my friend, Mike. 4 years, Mike drove a 2008 Toyota Camry. It was reliable, paid off, but it wasn't worth much. Its Kelley Blue Book value was maybe, on a good day, for $1,000. But Mike was paying nearly $800 a year for a full coverage policy, including collision and comprehensive with a $500 deductible. One day we sat down and did the math. If Mike totaled his car, the absolute maximum his insurance company would ever pay him was $4,000. But first, he'd have to pay his $500 deductible. So the real maximum payout was $3,500. Meanwhile, he was paying $800 every single year for the privilege of that potential payout. In just over 4 years, he would have paid the insurance company the entire value of his car in premiums. He was essentially buying his own car back from the insurance company on a terrible installment plan. This is the trap. We get so used to having full coverage that we forget to ask if it still makes sense. Here's the rule of thumb I told Mike, and the one you should use. It's called the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, you should seriously consider dropping it. How do you figure this out? First, go to a site like Kelley Blue Book or Edmunds and get a realistic private party value for your car. Let's say it's $5,000. 10% of that is $500. Now, call your insurance agent or look at your policy breakdown and find out exactly how much you are paying per year for just the collision and comprehensive portions. If that number is more than $500, you are paying too much for the protection you're getting. By dropping these coverages, you are self-insuring. You're taking a calculated risk. You're saying, "I'm going to take the $800 a year I was giving to the insurance company and put it in my own savings account. If I get in a wreck, I'll use that money to either repair the car or, more likely, use it as a down payment on a new one." For an older, paid-off car, this is almost always the winning strategy. You are severing a major cash pipeline to your insurance company. So go look at your policy right now. Find your liability limits and ask if they match your net worth. Find your collision and comprehensive deductibles and see how much you'd save by raising them to $1,000 or even $1,500. And most importantly, look up the value of your car and apply the 10% rule. Be honest with yourself. Are you paying hundreds of dollars a year to protect a vehicle that isn't even worth that much anymore? Adjusting these 3 things, your liability limits, your deductibles, and deciding whether to keep collision and comprehensive at all, are the big levers. This is how you can slash your bill by hundreds, maybe even over $1,000 a year. But we're not done. Because even after you've optimized these core coverages, your insurance company has another whole bag of tricks. They've likely padded your policy with a list of smaller, seemingly insignificant add-ons. Things that sound good on paper but in reality are often just a complete waste of your money. And that's exactly what we're going to expose next. Let's start with one of the most common upsells: rental car reimbursement. It sounds like a no-brainer, right? If your car is in the shop after an accident, the insurance company will pay for your rental. The agent sells it to you with a story. Imagine you're stranded, you need to get to work, you need to pick up the kids. For just a few extra dollars a month, we'll make sure you're never without a vehicle. It's an emotional sell, preying on your fear of inconvenience. But here's the reality they don't tell you about. First, look at the fine print. Most of these add-ons have a ridiculously low daily limit, something like $30 or $40 a day. Now, have you tried renting a car recently? In most major cities, $30 a day might get you a scooter if you're lucky. You're still going to be paying a significant amount out of pocket to get a standard sedan. So you're paying every single month for a benefit that, when you finally need it, barely covers a fraction of the actual cost. Second, ask yourself a hard question: do you even need it? If you're in a 2-car household, could you get by with one car for a week or two? Could you work from home? Could you carpool? The inconvenience might be minor compared to the hundreds of dollars you'll spend over the years for coverage you may never use. And here's the biggest secret of all. You might already have this coverage and not even know it. Many premium credit cards, the ones you probably have in your wallet right now, offer rental car benefits or significant discounts. So you could be paying your insurance company for a service your credit card company already gives you for free. It's time to become a detective. Pull out your policy, find that line item for rental reimbursement or transportation expense, and see what you're paying. Then check your credit card benefits. You might just find your first easy win. Next up is another classic padding tactic, roadside assistance. Again, the pitch is perfect. What if you get a flat tire in the middle of nowhere? What if your battery dies on a cold winter morning? For less than the price of a cup of coffee a month, we'll give you total peace of mind. And millions of Americans sign up, thinking they're being responsible. But this is one of the most redundant coverages in the entire industry. It's like paying for 2 Netflix subscriptions just to watch the same show. Why? Because there's a massive chance you are already paying for roadside assistance somewhere else. The most obvious one is AAA. If you're an AAA member, paying for roadside assistance through your car insurance is literally throwing money into a bonfire. You are double covered for the exact same service. But it doesn't stop there. Take a look at your cell phone bill. Major providers like Verizon and AT&T often have roadside assistance programs you can add for a few bucks a month, sometimes much cheaper than your insurer. More importantly, think about the car you drive. Almost every new car sold in America comes with a manufacturer's warranty that includes complimentary roadside assistance for the first few years. If you drive a Honda, a Ford, a Toyota, a Hyundai that's less than 3 or 4 years old, you are almost certainly covered. And let's go back to our friend, the premium credit card. Cards from American Express, Chase, and others often include roadside assistance as a standard perk. You are surrounded by safety nets. Yet your insurance agent conveniently forgets to mention them and happily charges you for one more. So right now, I want you to do a quick audit. Are you an AAA member? Is your car still under warranty? Do you have a premium credit card? If you answered yes to any of those, you need to call your insurance company and tell them to remove that charge immediately. Now let's talk about a sneakier one, something called Custom Parts and Equipment Coverage, or CPE. This one is designed to cover aftermarket additions to your vehicle. We're talking about that expensive sound system you installed, those fancy custom rims, that special paint job. If you've spent thousands of dollars modifying your car, then yes, this coverage is absolutely essential for you. But here's the thing. What percentage of the American driving population has actually done that? Tiny fraction. The vast majority of US are driving stock vehicles, exactly as they came from the factory. Yet, insurance agents will often try to sneak this coverage onto a policy. They'll say, it's just a couple of extra dollars a month, and it provides extra protection just in case. But just in case of what? If your car is completely stock, you have 0 custom parts to protect. You are paying for a benefit that is literally impossible for you to ever claim. It's pure 100% profit for the insurance company, collected from millions of people who don't know any better. Think about it. Your standard collision and comprehensive coverage already covers your car and all of its factory-installed parts. That's the whole point. CPE is only for things that were added later. If you haven't added anything, you don't need it. Go through your policy declaration page with a fine-tooth comb. If you see a line for custom parts and equipment or aftermarket coverage, and you're driving a standard unmodified car, you found another financial leak that needs to be plugged, effective immediately. Finally, we have to tackle the big one, the most misunderstood add-on of them all, gap insurance. Now this is different. Unlike the others, gap insurance isn't always a waste of money. In fact, in one specific situation, it is absolutely critical. Gap insurance covers the gap between what your car is actually worth and the amount you still owe on your loan. Let's say you buy a brand new car for $30,000. You put very little money down and take out a long 72-month loan. The second you drive that car off the lot, it depreciates. A year later, it might only be worth $22,000, but you could still owe $27,000 on your loan. That's a $5,000 gap. If you get into a major accident and your car is totaled, your regular insurance will only pay you the car's current market value, $22,000. You would still be on the hook for that extra $5,000, left with no car and a massive bill. In that scenario, gap insurance is a lifesaver. It pays off that $5,000 difference. So, if you have a new car with a large loan and a small down payment, you need gap insurance. But here is the multi-billion-dollar secret. Millions of Americans keep paying for it long after it has become completely useless. As you make your monthly payments, two things happen. Your loan balance goes down, and your car's value continues to depreciate, but at a slower rate. Eventually, you reach a point where your loan balance is less than the car's market value. The gap has closed. You are no longer upside down on your loan. From that moment forward, every single dollar you pay for gap insurance is a complete and total waste. The coverage provides you with zero benefit because there is no gap to cover. People finance a car, get gap insurance, and then just forget about it for the next 6 years. They might pay it off, they might be 3, 4, 5 years into the loan, and they're still paying that monthly premium for a problem that no longer exists. So here is your mission, and it's one of the most important things you'll do all year. First, go to a site like Kelley Blue Book and find the current private party value of your car. Write that number down. Second, log into your auto loan account online or look at your latest statement and find the exact payoff amount. Now compare the two numbers. If your car's value is greater than what you owe, you need to call the company that provides your gap insurance, which might be your car insurer or a separate company you bought it from at the dealership, and you need to cancel it today. This one trick alone can save people $50, $60, even $70 a month. We've just trimmed the fat from your policy, cutting out the rental reimbursement, the redundant roadside assistance, the useless custom parts coverage, and the expired gap insurance. These are the sneaky parasitic costs that drain your bank account month after month. But we're not done. We're just getting warmed up. The real savings, the thousands of dollars, are hidden in the core of your policy. The big three coverages that everyone has but almost no one understands: liability, collision, and comprehensive. And cracking that code, turning those complex terms into simple money-saving decisions, is what we're doing next. Alright, let's break it down. Think of these three coverages not as boring insurance terms, but as three different shields protecting you from financial ruin. Each one defends against a very specific type of attack. Get this right, and you're not just saving money, you're building a fortress around your financial life for pennies on the dollar. First up, the big one. The one that's not optional. Liability coverage. The name itself is a hint. It's for when you are liable. When an accident is your fault. This shield isn't for you. It's for everyone else. It doesn't pay a dime to fix your car or your own medical bills. It pays for the damage you do to other people and their property. This is the coverage that keeps you from being sued into oblivion and losing your house because you glanced at your phone for 2 seconds and rear-ended a surgeon in a new Mercedes. Liability is split into two parts. You'll see it on your policy as a series of numbers like 25/50/25. This looks like a secret code, but it's incredibly simple once you know how to read it. Let's decode it. The first number, 25 in this case, stands for $25,000. That's the maximum amount your insurance will pay for any single person's medical bills in an accident you cause. The second number, 50, is the maximum total it will pay for all medical bills in that single accident, no matter how many people are hurt. The final number, 25 again, is the maximum it will pay for property damage. That's the other person's car, the mailbox you hit, the storefront you skidded into. So 25/50/25. That's the state minimum in many places. And here is the first secret, the one that could save you everything you own. State minimum is a financial trap. It's a dangerously low amount of coverage. Think about it. One minor surgery can blow past $25,000. A decent new car costs more than $25,000. If you cause an accident where the costs exceed these limits, guess who pays the rest? You do. They will come after your savings, your investments, your paycheck. They can even put a lien on your home. Now you're probably thinking, great, so I need more coverage, which means a higher bill. And this is where the insurance game gets interesting. The jump from state minimum liability to something actually protective like 100/300/100 costs shockingly little. We're often talking about a few extra dollars a month. Why? Because the insurance companies know that the vast majority of accidents are small fender benders that fall within the low limits. The catastrophic multi-car pileups are rare, so they don't charge a fortune for that higher protection. For the price of a couple of fancy coffees a month, you can increase your financial shield from the size of a dinner plate to the size of a castle wall. This is the single smartest, cheapest upgrade you can make to your entire policy. Do not skimp on liability. Okay, shield number 2, collision coverage. This one is simple. Collision covers damage to your car when you collide with something. Another car, a pole, a guardrail, a fire hydrant. If you are at fault, this is the coverage that fixes your vehicle. If the other driver is at fault, their liability coverage is supposed to pay for your car. But if they're uninsured or it's a complicated mess, your collision coverage can step in to get you back on the road fast, and then your insurance company will go fight the other guy to get their money back. Now, unlike liability, collision is often optional, unless you have a loan or a lease on your car. If you do, the bank requires it because technically it's their car and they want to protect their asset. The key to saving money on collision is one word: deductible. The deductible is the amount of money you agree to pay out of pocket for a repair before the insurance company pays a single cent. It's your skin in the game. If you have a $1,000 deductible and you have a $4,000 repair, you pay the first $1,000, and the insurance company pays the remaining $3,000. This is your primary control knob for your premium. A low deductible, say $250, feels safe, but you will pay for that safety every single month in the form of a higher premium. A high deductible, like $1,000 or even $2,000, will dramatically lower your monthly premium. Why? Because you're telling the insurance company, "Don't bother me with the small stuff. I'll handle the dings and dents. I only need you for a major, expensive wreck." This saves them administrative costs and reduces their risk, so they give you a better price. So what's the right deductible? The answer is personal. The secret is to choose the highest deductible you can comfortably afford to pay at a moment's notice. Don't pick a $2,000 deductible to save $40 a month if you don't have $2,000 in an emergency fund. That's a recipe for disaster. But if you do have a healthy emergency fund, raising your deductible from $500 to $1,000 is one of the fastest ways to slash your premium without taking on an irresponsible amount of risk. That brings us to our third and final shield: comprehensive coverage. This is the everything else shield. It protects your car from things that aren't a collision. Think of it as the act of God or bad luck coverage. A tree branch falls on your car during a storm. A deer decides to redecorate your front grille on a country road. Your car gets hailed on and looks like a golf ball. It gets stolen. It gets vandalized. Fire, flood, riots. That's all comprehensive. Just like collision, it's usually optional unless you have a loan, and it also has a deductible that works the exact same way. And just like collision, raising that deductible will lower your premium. But comprehensive is where the biggest money-saving trick of all comes into play, especially for those of you with older cars. It's the art of knowing when to drop collision and comprehensive coverage entirely. Insurance is designed to protect you from a financial loss you can't handle. If you're driving a 15-year-old car that's paid off and is worth, say, $3,000, does it make sense to pay $800 a year for collision and comprehensive coverage with a $1,000 deductible? Let's do the math. In a worst-case scenario, your car is totaled. The insurance company cuts you a check for its value, which is $3,000, but only after you pay your $1,000 deductible. So, you get $2,000, but you paid $800 for the privilege. Was it worth it? Maybe not. Here's a powerful rule of thumb that insiders use: the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, you should seriously consider dropping it. You can look up your car's value on Kelley Blue Book or a similar site. In our example, 10% of the car's $3,000 value is $300. Since the $800 premium is way more than that, you'd be better off dropping the coverages, banking that $800 a year yourself, and creating your own car repair or replacement fund. You are self-insuring. So let's put it all together. Liability is your shield against the world, protecting your assets. You want this shield to be as big as you can affordably make it. Collision is your shield for your car against your own mistakes. Comprehensive is your shield for your car against the universe. For these two, you use the deductible as a tool, and for older cars, you have the option to drop them entirely. Understanding how to manipulate these three core coverages, raising liability while raising deductibles or dropping unnecessary coverage, is how you transform your policy from a generic, expensive bill into a tailored, cost-effective suit of armor. But these three are just the beginning. They're the main event, but there are other, smaller coverages hiding on your policy page. Some are critically important, and some are just expensive add-ons you probably don't need. And one of them, medical payments coverage, is one of the most misunderstood and misused parts of any policy, and getting it right could save you hundreds. We're diving into that hidden world next. Let's talk about medical payments coverage, or MedPay. This is the one you see on your policy for a few bucks a month, maybe $10 or $20, and you think, sure, medical coverage, that sounds responsible. But here's the secret your insurance agent might not tell you. For the vast majority of Americans with decent health insurance, MedPay is one of the most redundant, overlapping, and frankly wasteful coverages you can buy. Here's how it works. MedPay is a no-fault coverage. That means if you're in an accident, it pays for your medical bills and your passenger's medical bills up to a certain limit, usually something small like $5,000 or $10,000, regardless of who was at fault. It's designed to be fast. While the insurance companies are spending weeks or months fighting over who caused the crash, your MedPay can immediately cover your health insurance deductible, your copays, or that ambulance ride. Sounds good, right? But think about what I just said. It covers your health insurance deductible. It covers your copays. What does that imply? It implies that it's working in the exact same space as your primary health insurance. It's like buying a special, separate insurance policy just to cover the cost of your morning coffee, when you already have a debit card in your wallet that can do the exact same thing. If you have a solid health insurance plan through your employer or the marketplace, it's already going to cover your injuries from a car accident. Yes, you might have a deductible to meet. You might have some out-of-pocket costs, but you are already insured for the big, scary, bankrupting hospital bills. Paying extra every month for MedPay is essentially buying insurance for your insurance. You're paying a premium to cover a potential deductible that you might have to pay anyway. Now, agents will sell you on this with two main arguments. First, they'll say it's for your passengers. What if you get into an accident and your friend in the passenger seat gets hurt? You want to be able to take care of them, right? It's a powerful emotional pitch. But let's break it down logically. If another driver hits you, their bodily injury liability insurance is responsible for your friend's medical bills. That's what it's for. If you are at fault, then yes, your MedPay would be the primary source of coverage for them. But what are the odds that your passenger doesn't have their own health insurance? In this day and age, most people do. So again, your MedPay is just covering the copay for someone who already has coverage. You have to ask yourself, is it worth paying an extra $100 or $200 a year every single year for the rare chance you need to cover a friend's $20 urgent care copay? For most of us, the math just doesn't add up. The second argument is that it's peace of mind. But true peace of mind doesn't come from having 5 different policies that all do the same thing. It comes from having strong coverage where it matters and not wasting money where it doesn't. So here's the action plan. Pull out your policy. Find the line for medical payments. Now think about your health insurance. Do you have a low deductible? A reasonable out-of-pocket maximum? If the answer is yes, you can most likely slash this coverage down to the absolute state minimum, which in many states is nothing or maybe $1,000. The savings will drop right to your bottom line. Now, I have to give a major disclaimer here. If you do not have health insurance, or if you have a catastrophic high-deductible plan that would be financially crippling to use, then MedPay can be a valuable, low-cost safety net. Also, some states, known as no-fault states, actually require a similar but more robust coverage called Personal Injury Protection, or PIP. PIP is different. It not only covers medical bills but also lost wages. If you're in a PIP state like Florida or Michigan, you have to carry it. But for the rest of us in states where MedPay is optional, it's one of the first things you should question. And MedPay is just the tip of the iceberg. Your policy is likely littered with other small, seemingly cheap add-ons that are just profit drivers for the insurance company. Let's talk about rental reimbursement. This covers the cost of a rental car while yours is being repaired after an accident. It sounds essential. Who can be without a car? But look closer at the coverage. It's often limited to something like $30 a day for 30 days. Have you tried to rent a car for $30 a day recently? You'd be lucky if that covers the taxes and fees on a subcompact. So you're paying every month for a benefit that, when you actually need it, is only going to cover a fraction of the real cost, leaving you to pay the rest anyway. Ask yourself the hard questions. Do you have a second car in the family? Does your spouse? Could you work from home for a week? Could you use Uber or Lyft? The money you save by dropping this coverage for 3 or 4 years could easily pay for a full week's rental out of pocket if you ever actually needed it. And remember, if the accident is the other person's fault, their insurance company is on the hook for your rental car, making your own coverage totally irrelevant. Next up, roadside assistance. This is the biggest offender for duplicate coverage. Insurance companies love to sell you their towing and labor plan for a few bucks a month. But stop and think. Do you have a AAA membership? Does your credit card, especially travel cards like the Amex Platinum or Chase Sapphire Reserve, offer complimentary roadside assistance. Did your car come with a manufacturer's program like OnStar, Toyota Care, or Ford Pass? I've met people who were unknowingly paying for 3 separate roadside plans at the same time. You are lighting money on fire. Check your other memberships and benefits before you give one more dime to your auto insurer for a service you're probably already getting for free. And what about gap insurance? This one is critical, but only for a very specific window of time. Gap insurance pays the difference between what your car is worth and what you still owe on the loan if your car is totaled. When you buy a brand new car and put very little money down, you are upside down on that loan for the first couple of years, meaning you owe more than the car is worth. During this period, gap insurance is a non-negotiable lifesaver. But what happens after 3, 4, or 5 years of payments? You start to build equity. Eventually, you reach a point where the car's value is actually more than your remaining loan balance. From that moment on, every single dollar you pay for gap insurance is pure waste. It can provide absolutely no benefit to you, because there is no longer a gap to cover. Yet insurance companies will happily keep charging you for it until the day you pay off the car. It's on you to track it. Go to Kelley Blue Book, check your car's value, then check your loan statement. The second your car is worth more than you owe, call your agent and cancel gap coverage. It's an instant savings of $50 to $100 a year. By being ruthless and analytical about these add-ons, MedPay, rental, roadside, and outdated gap coverage, you can trim the fat from your policy without sacrificing a single ounce of meaningful protection. You see, the great irony of auto insurance is that most people are tricked into being overinsured on the small manageable stuff, the $1,000 risks, while being terrifyingly underinsured on the big life-destroying risks. We've spent all this time cutting the fat, trimming the waste, and saving you hundreds, maybe even thousands of dollars. But all of this is for nothing if you make one critical mistake. A mistake that could cost you your house, your savings, and your entire future. In our final part, we're going to talk about the single most important number on your entire policy, the one place you should never skimp, and how getting it right is the ultimate secret to being properly insured without being overcharged. That number, the one that can make or break your entire financial life, isn't your deductible. It isn't the cost of your comprehensive coverage. It's your liability limit. These are the 3 numbers you see on your policy, often written out like 50/100/50. And understanding what they mean is the absolute key to being properly insured. This is the firewall that stands between a simple mistake on the road and losing your home, your savings, and your future wages. This is the one area where trying to save a few dollars a month can cost you hundreds of thousands of dollars later. So let's break it down because it's not complicated. That first number is the maximum amount your insurance will pay for bodily injury to a single person in an accident that you cause. The second number is the maximum they'll pay for bodily injury for the entire accident, no matter how many people are hurt. And that third number is the maximum they'll pay for property damage you cause, which usually means the other person's car, but could also mean a fence, a storefront, or a telephone pole. Let's say you have a policy that's 50/100/50. That means your insurance will pay up to $50,000 for one person's medical bills, up to $100,000 for everyone's medical bills combined, and up to $50,000 to fix or replace the car you hit. Now you might be thinking, $50,000 sounds like a lot of money. I'm covered. And this is the single biggest, most dangerous misconception in all of auto insurance. It's a financial trap that millions of Americans are unknowingly caught in. Let's paint a picture. You're driving home from work, you glance down at your phone for just a second, and you rear-end a brand new SUV. It's not a high-speed crash, but the driver complains of neck and back pain. The ambulance comes. They go to the emergency room. Let's do the math. The average cost of a new SUV today is well over $50,000. Your $50,000 in property damage might not even cover the replacement cost of their vehicle. But that's the small problem. The real problem is the person. An ambulance ride can be a few $1,000s. An ER visit with a CT scan can easily be $10,000 to $15,000. Now they need physical therapy for a few months. That's another $10,000. Maybe they need surgery. We are now soaring past your $50,000 per person limit like it's standing still. And what if it wasn't just one person? What if you hit a minivan with a family of 4 inside? Your $100,000 total bodily injury limit could be exhausted before the first round of medical bills is even processed. Here's the terrifying part. When your insurance limit is reached, the insurance company writes the check, wishes you luck, and walks away. But the bills don't stop. The other party's medical expenses, their lost wages from being unable to work, their pain and suffering. That all becomes your personal responsibility. The other driver's attorney won't just shrug and say, "Oh well," they will come after you. They will sue you personally. And they will go after everything you have. Your savings account, your retirement funds, your house. They can even get a judgment to garnish your future wages for years, even decades to come. One moment of distraction, one bad decision on the road, combined with a cheap, low-limit insurance policy, can literally bankrupt you and saddle you with debt for the rest of your life. This is why state minimum insurance is one of the biggest financial scams in the country. Many states have shockingly low minimum requirements. In California, it's 15/30/5. That's $15,000 for one person's injuries, $30,000 total, and a laughable $5,000 for property damage. $5,000 won't even cover the repair of a fender bender on a modern luxury car with all its sensors and cameras. A state minimum policy isn't designed to protect you. It's designed to meet the bare minimum legal requirement to operate a vehicle. It protects everyone else from you, but it offers almost zero protection for your own assets and your own future. Driving with state minimum liability is like going into a sword fight armed with a plastic butter knife. You are financially naked. So here is the ultimate secret, the single best piece of advice in this entire series. Increasing your liability limits is the cheapest and most valuable upgrade you can possibly make to your auto insurance. The price difference between a dangerously low state minimum policy and a genuinely protective policy is often shockingly small. Going from, say, 25/50/25 to 100/300/100 might only cost you an extra $10 or $15 a month. Think about that. For the price of a couple of coffees, you are quadrupling your financial protection. You are buying hundreds of thousands of dollars of peace of mind. There is no other financial product on earth that gives you that kind of leverage and security for such a tiny cost. So what should your limits be? For the vast majority of people, the answer is a bare minimum of 100/300/100. 100,000 for a single person's injuries, 300,000 total per accident, and 100,000 for property damage. This is a solid foundation that will cover the vast majority of accidents you could ever find yourself in. It moves you from the danger zone into a place of reasonable safety. If you have more assets to protect, a house with equity, significant savings or investments, you should be looking at even higher limits like 250/500/100. And for those of you with a growing net worth, the next step is an umbrella policy. This is a separate insurance policy that kicks in after your auto or home insurance limits are exhausted. You can often buy a $1 million umbrella policy for just $200 or $300 a year. It's incredibly cheap, but most insurance companies won't even sell you one unless you first have high underlying limits on your auto policy, usually that 250/500/100 level. It's the final layer of your financial fortress. So let's bring this all home. Over these 10 parts, we've covered a massive amount of ground. We've talked about the power of shopping around and how loyalty to one company can cost you a fortune. We've discussed bundling your home and auto, and the double-digit savings it can unlock. We've gone through the long list of discounts you need to be asking for, from good student to defensive driving to the dozens of others you probably qualify for. We've talked about the strategic use of a higher deductible to lower your premium, but only if you have the cash to back it up. We've revealed how your credit score is a secret driver of your insurance rates and what you can do about it. We've covered how telematics and usage-based insurance can reward your safe driving habits with real dollars. We've talked about choosing the right car and how that impacts your rates before you even buy it. And finally, we've just uncovered the single most critical part of your policy: your liability limits. Your mission, should you choose to accept it, is to stop being a passive consumer of insurance and become an active manager of your own financial protection. Insurance isn't just a bill you have to pay. It's a tool you need to wield correctly. So here is your final call to action. I want you to do this today. Not tomorrow, not next week. Find your auto insurance policy declaration page. You can probably pull it up on your phone right now. Look for those 3 liability numbers. If you see numbers like 15/30/10 or 25/50/25, you need to recognize that you are one unlucky moment away from a potential financial catastrophe. I want you to call your agent or go online and get a quote to raise those limits to at least 100/300/100. I promise you, the increase in your premium will be far smaller than you fear, and the increase in your peace of mind will be immeasurable. This is the single smartest, most impactful, and highest value change you can make. It's not about spending more money. It's about spending your money wisely to protect everything you've worked so hard to build. Take control. Protect your future. You have the knowledge now. Go use it.